What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are live trading two double calendar options strategies here. So if you've watched my previous video about how I made $100 into $1,000 with Nike options, I'm going to do the same thing, playing earnings again coming up within the next 2 weeks. Now, the two companies I'm looking at getting filled for these positions here are Charles Schwab and American Express. These companies are both announcing their earnings in about 2 weeks or so. We're going to break down what we're looking for here in this case. I'll also review my Delta Airlines trade as well at the time of recording this video as to where we are looking at overall. So if you're excited for today's video, feel free to like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. Now, since we're recording this on July 3rd, the market closes at 1 p.m. Eastern time instead of 4 p.m., so we had to get this video out recorded a little bit earlier because the market closes in about 15 minutes. So what we're looking at is Charles Schwab, and what you will notice is that they do have their earnings coming up on July 18th pre-market. And one of the things I like to think about for this option strategy here is to make sure that it trades pretty close to an expiration date. So Thursday before the expiration on Friday, or Friday pre-market, or something like that, because it allows me to close out the short legs at the latest possible time. And we'll talk about what that means and how we can break it down and everything here. So basically what we're looking at is Charles Schwab here. And again, their earnings are the 18th pre-market before market opens. And what I like to kind of do is look at two different ways of figuring out what the market is looking for a move in Charles Schwab. Okay, so one way you could do it is you could just Google it, research it, and on options AI, they don't have Charles Schwab for this one. They have it for American Express, where their earnings are Friday the 18th. They're looking at about a 5% move in either direction for American Express. They don't have it for Schwab. I don't know why. I'll have to keep looking back on next week. But the other way that you could do it is to say, I'm going to buy a call and buy a put at the same strike. And it creates what's called that straddle option. And what this basically does is it factors in this idea saying as to where is it expected to move until you get that break-even point. It's a very common strategy I hear from a lot of people. And what you're seeing is that you're looking at Schwab to have basically about a 5 to 6% move in either direction, about 5.99%, about 6% here, and about 5.5% to the downside. And so how we're going to be looking at this here, saying, okay, well, the break-evens for this straddle here is going to be 86.76. I'm going to round that down to 86, so I give us a little bit of buffer. And then 97.24, I'm going to go to 98. So I'm going to set my strike prices first at 86 and 98. Now, how is this going to work? So I'm going to first sell an option at $98, just like so. And I'm going to sell a put option at 86, which were my two strike prices that I based off of the straddle from the options chain. Now, selling these options here obviously gives me a premium. So upfront, I'm getting paid $139. But the problem with just selling options and not buying them, or not having the shares for them, is that if you get exercised, you can get margin called as a result. So what we can do instead as a result of that is to buy underlying contracts that count as 100 shares for my collateral. But the idea here is to not buy them for the same expiration date, which is the July 18th. The reason why is because, again, there's a lot of implied volatility that will be baked into these options here. And say Charles Schwab doesn't have a lot of movement in the stock, then those options are going to lose value faster. So what I do is I create what's called a double calendar. And the idea behind it in a calendar strategy is it's the same strike price, but different expiration dates. So this is what I'm picking to have it as right at earnings for the sold options. I'm going to go 1 week out for the bought options. So I'm going to buy the 86 put here. I'm going to buy the 98 call here. And what you'll notice is that it creates this kind of double calendar strategy here. So basically, if Schwab moves between 6% over here and between 6% down here, I'll be able to capitalize in some way, shape, or form. And again, the idea behind it is to hope that there is some decent movement after earnings as a result. And what the really nice thing to notice is that your max loss, or how much it costs to open the trade, is about $30 or so, and your profit is about $130. So I'm going to open up this trade here, and I'm picking Schwab as one of them because it's actually not a bad I'm gonna get filled a little bit higher, I think, as a result as a result, because I'm still battling being sick also. Let me see if I can get filled here. I'm trying to think about what I can get filled at. Do like 0.32 maybe. Let me see what are the bid asks looking like right now. 0.3. So let's do like 0.33 maybe and see if that gets filled. So we'll put that in there and see what happens here. That's going to create a double calendar. Hopefully we get filled here. We shall wait and see. There we go. Perfect. So you have a new position there in Schwab. So basically $33 to pay for it. It's a 4-leg option strategy here. And the other one that we're looking at is American Express. So now American Express, as we know, they're looking at about a 5% move in earnings. So we're going to go to trade options here. Again, and take a look at July 18th. You could buy the call option here. You can buy the put option to see that they are indeed looking at about a 5% move in either direction. So it kind of lines up in that way as a result. So for American Express, what you'd be able to do, and again, I'm doing it with American Express and Schwab because of liquidity, because again, you're doing 4 options at the same time. If it's an illiquid stock, you might have a possibility of getting filled, obviously, at a lower price than you want to, or at a higher price than you want to, and that makes you have more losses. Again, you saw me pay like $2 or $3 over asking for the Schwab one, and they're more of a liquid one anyways. So we're looking at a break even of 312.6 and 347. So the thing with American Express is that they trade in increments of, $202.50 strikes here, but the next week trades in increments of $5 increments. So that means I'm going to round this down to 310 and to 350. So my 2 strikes I'm looking at are going to be 310 and 350. So we're going to sell at 310. We're going to sell at 350. It creates this nice little option here. Again, these are naked options at the moment in time, which we don't want because I don't have, all their shares available for that one. But then we can go to July and we can go ahead and we can buy the call option at 350. Again, a week after earnings. Earnings are the 18th. We go a week out afterwards. So that way implied volatility doesn't crash these prices as much. And I'll explain why in just a minute. And this creates, again, a nice little option you have. Again, this one's going to cost us about $125 or so, but a decent return potential of, you're looking at $400 and something here. So we'll see if we can get filled here. Again, the bid ask here is a little bit of a interesting one to say the least, only obviously because of, we'll do 130, maybe we'll get filled at 130 here. Only because, again, with the options chain, it's a kind of a pain in the butt in this case because, again, you're doing 4 contracts at the same time. So we'll see if we can get filled at 130. I don't know if we will. Doesn't seem like it. Let's see if I can replace this. See what we're looking at now. I guess we try 130 again and see. This is the one thing that really sucks about doing these like advanced level options here. 1.32 maybe. Try to give them a little bit more of a price up front here. Let's see what happens. Come on, there we go. Okay, 132. So we got filled a little bit higher, obviously. So we're going to be down a little bit on that position already because of obviously the strike prices and everything else. But the goal behind it here is to think about managing here. Now, I'll pull up my example of Delta Airlines right now that we're looking at here. And how Delta Airlines is working is kind of what I'm looking at right now. So with my Delta Airlines position that I have right here, again, as you'll see, I did 3 contracts here for about $105 here total. This is what it costed me. It's a 4-option strategy. I'm looking at Delta Airlines between $45 and $55, doing the same kind of thing I just showed you. Look at the expected movement, look at doing a call and a put straddle and seeing what the break-evens are going to be about, and then using that to my advantage. So here's how this is going to work. And this is how I did Nike earnings as well, same thing. So we're going to try it out with these other ones and see how it goes. So with Delta Airlines here, their earnings are coming up next Thursday pre-market. So what I will be doing is I will be closing the short side, which is these selling options here. I'm going to close both of these on July 9th before the market closes because they have their earnings announced in the morning before market opens of July 10th. The reason why I want to close these short options before earnings is because any kind of dramatic move, because if you take a look at what they're looking at for earnings next week, they're looking at a 7.6% move in Delta Airlines. That very well could push this option here into the money at 55 or 45. So if I simulate this here, we take a look and see what that would put us up to. Let's take a look here. Let's climb this up, climb this up, climb this up, climb this up, climb this up. So 7% puts you at about 54, maybe 55-ish dollars or so as a result of this trade right here. And the idea behind this option strategy here is, again, selling the options here or closing these sold short options here before earnings, because it's going to hopefully maximize the premium that you will collect from theta decay. With us having a long 3-day weekend, these options are going to lose a lot more in value over the weekend because it'll only be 4 days until earnings. Right now it's 7 days. So you're going to take away some time and there's less chance of these to hit in the money. So it's going to lose value relatively quick. For example, taking a look at this Delta $45 put that I have here, it's already gained me $117, about half of the value. Monday morning comes, this is probably going to be very, very similar. It's going to be actually probably worth a little bit more, and I'm going to be able to close this out for a profit. Now, with the calls here, same thing. These ones are actually down a little bit because we've had a green day in Delta Airlines today. But again, $55 strike price, I'm still looking at almost like 10% away, 9% away for it to be basically in the money here. So this is going to lose a lot of value, as you will see over the weekend come Monday morning. So the goal is to close both these sold options on Wednesday before market closes and to make that premium collected. I paid $105. Say I close it for $205. I'm up $100 on the trade at the moment in time. But then what does that leave me with? That leaves me with a long straddle. Or long straddle? Long strangle? Long strangle. Because strangle is two different strike prices here. I have a $45 put and a $55 call. And take a look at the options here. Basically, this is what I'm leaving it with. I'm leaving it with a call and a $45 put. So I'm basically left with this right here. And I'm basically looking to basically see that is if Delta has some sort of movement, these options may lose value. But since I went so far out, a week after earnings, there hopefully won't be as much implied volatility crush on these options here. So that's kind of what the hope is with these kind of trades here. So say that, and we can break down these numbers in a lot more in depth here, but I'm not going to go too crazy with it. Say we close the short options for $300 in profit here, total. Say we do it for $300. We make $300 from here, we paid $105, so we're up $200 here. Say the bought options, earnings comes out, it kind of sucks, and it loses like, $50-$60. We're still up $107 on the trade overall as a profit that we started with $105. So we still basically doubled our money return as a result of this trade here. That's what happened with Nike last week. And Nike last week, we had a killer in earnings because it had a huge move in the expectations. And that's kind of what the hope was for us as a result. So we're doing it now with Delta Airlines. They're looking at a huge movement here. So again, 7 or 8% movement, give or take, which to me, I think is going to be a pretty decent option to take a look at here. And what we could do is, if you look at the 55, let's take a look here. See if we can do a little simulation here a little bit. So here's Delta Airlines right now. And again, even if it has, like that 7% movement here, again, this is at expiration, right? So this is at the expiration date and time itself. Obviously, we're going to have a whole week to go still. So it's still going to lose some value, but just not as much value as a result. If Delta Airlines has a huge beat or a huge miss and it goes up or down 10% or whatever the case is, that is where we're going to maximize those profits there. So the idea is to play earnings, use the short options to offset our cost basis, and then hope the straddle pays off well for us as time goes on. So we're going to break down the strategy more next week. My goal is to live stream Delta, the chart of Delta stock Thursday morning before the market opens, so we can watch it and see what happens on the live stream. We can look at what I'm looking for here and what we're going to expect as a result. So 2 new trades we're looking at. Again, we got Schwab now, and now we have American Express. So 2 financials to work with here. We're 1 for 1 with Nike. We got Delta next week, and we're going to keep the strategy going and see how we do. So thank you guys so much for watching today's video. If you made this far in the video, as always, feel free to like the video, subscribe to the channel, and as always, turn on those bell notifications for all future uploads. I hope you're making money in the markets some way, some shape, some form. And as always, I will see you guys in the next video.